The VIX is rising and smart money just turned red on the daily and the weekly time frame. Here's what the charts say next. Markets are turning bearish as the red signals stack up and the VIX is rising. Technology and semiconductors are taking a dive and are among the weakest sectors. Are we seeing the unwind of the famous AI bubble? Sector strength. Tech falls off a cliff as energy rises and defensives are gaining momentum. Despite the sell-off, data center hardware demand remains exceptionally strong with no clear slowdown into Q3 earnings. Recent results from Intel, AMD, Besi and Supermicro point to sustained AI infrastructure spending by hyperscalers supported by record semiconductor equipment orders, expanding AI server production and improving outlook across the supply chain. The main risk, however, now is the execution. Power grid constraints, transformer shortages and increasingly demanding expectations after a sharp sector rally. The key question for earnings is whether growth can continue to exceed the market's already lofty expectations or delusions. This is a smart money tracker. We rarely see that many bearish signals at once. The smart money tracker has turned red on both the daily and the weekly time frames, with seasonal weakness ahead until October, the midterm elections. The S&P also closed below the dominant moving average, which has acted as a support during the famous rally in spring. And this basically opens the gate as we see very few accumulation zones until the daily moving average, 100 and 200 days. So the 7,000 level is basically in the cards. For the first time in a while, our composite risk indicator spikes to yellow. Most volatility gauges are only slightly elevated, but Nasdaq volatility increased notably, rising near-term downside risk. The big pressure points are crude oil, which is trying to reclaim the $100 level, and significantly elevated US Treasury rates, which we pointed out earlier this week. And they are pressuring the Fed and driving higher SOFR volatility, which is an early warning signal. High Treasury yields threaten expected Fed rate cuts, and alongside rising inflation, this could limit the Fed. They might even have to raise rates again, and that's toxic for markets. This rather complex looking chart shows a variety of signals. First of all, we have the rates of these different US Treasuries, ranging from the 3-month rate, which are greenish, over the 2-year to the long-term end, which is slightly higher and rising above 5. So these are those colorful lines, and all of them are rising. What we see here is the reciprocal of the Fed funds rate, so something corresponding to the Fed rate. And we see the S&P 500 in the background. So whenever the Fed rises the rates, typically this is not absorbed in a bullish manner by the market. That reminds us 2022. However, I have to point out that the 3-month rate sometimes precedes the Fed rate, and it's an early warning sign. And right now, The 3-month yields are rising, putting the Fed under pressure. Given current money flows, capital is rotating away from US equities and bonds towards commodities and currencies. Our commodity screener can help surface opportunities as the commodity index is in a strong upward trend right now. It's led by energy, crypto and metals, and even grains. A particularly interesting market is lumber, which I discovered today, which is currently in a COT risk-on regime. The COT is the Commitment of Traders report that tells you when large traders or producers are going long in an asset. And we see suspicious insider buyings in many lumber stocks. Here's an example, the analysis chart of Javed Cameron Trading Company, which shows a recent cluster of insider buyings. And this comes after a long basing pattern over the course of the last week, with many dark pool trades at the bottom. These are those purple bubbles. So what does it tell us? At least insiders are buying their own stocks. They might know something, which seems to be crucial, and combined with the information from the COT, this is very useful.
For deeper charts, tools and screeners, visit Markets in Vitro.